Thanks, Abha, so much for that. Let's take this forward with Andrew Freris of Ecognosis Advisory. Andrew, thanks so much for taking out time for us. What is your expectation in terms of trade deal? Will something be worked out before the tariff, the talks end today?
Issue, however, is that the markets have hugely exaggerated the impact on both the Chinese and the American economy. Chinese economy is not driven by trade. It is not driven, NOT, it is not driven by trade. And therefore, any drop in exports will have a very, very small impact on Chinese GDP growth. It will have impact on region and it will have impact on individual companies. But macroeconomically, the impact is likely to be very, very small. So the Chinese rightly are holding out. They are not giving in on everything the Americans are asking. And in all probability, Trump will continue, with the increase in tariffs, which are supposedly taking place sometime on Friday, although the discussions will continue. Therefore, I suspect that the slight recovery of the equities today might be a little bit premature. In a way, actually, I didn't mind at all seeing equities coming down very severely at the back of what I consider to be nonsensical fears, because I never really bought into the huge recovery of equities after the colossal drop during December and early January this year. In other words, there were really no important reasons. And it was shown by just a scare about the United States-Chinese trade war as if this was news at all.
Is the outlook on market intact after the yield inversion once again in US?
Over-exaggerated because the yield curve tends to invert in individual parts of the yield curve. It is not an overall. In other words, the classical one is 2 years to 10 years. Now, yesterday, it was 3 months to 10 years. In other words, commentators tend to take individual pieces and stick on to that. There is now a widespread consensus, growing consensus, that inversion of yield curve is not anymore a good predictor of recession, because we have nearly 10 years of exceptionally low interest rates that may well have distorted the relationship between an inversion and GDP growth. So I'm afraid I completely ignored yesterday's inversion. I don't think that's of any significant importance.
What is the range that you would see for crude oil prices?
The situation of oil is being complicated, but by what is likely to happen in Iran now that Trump has reimposed all the trade restrictions, and in fact removed exceptions that were given for the export of Iranian oil to a number of economies. So I would not be surprised if we're going to see a slight increase. The overall oil demand is likely to be supported by the fact that three major economies, and that was the United States, China, and the European Union, had very strong first quarter GDP growth. And again, this is something that has been completely ignored by the markets, but never mind. So I will not be surprised to see some firming on oil prices.
Is gold going to be the preferred asset this year with the sort of move that you've seen in some of the other asset classes?
Whilst we are having continuously low inflation, and at the same time we are having low interest rates, meaning that the Fed is unlikely to increase interest rates anytime soon, then the two factors cancel each other out. In other words, low inflation, is bearish for gold. Lower interest rates are bullish for gold. So the two things effectively cancel out. So I'm afraid also I have stopped looking at gold as an indicator of either panic or bull in a period, again, that has had 10 years of exceptionally low interest rates, all of which are effectively bearish for gold. Okay.
What is your view as far as Indian market goes with the election verdict just around the corner?
We still have a few days to go till we know the final election results, but very likely it's going to be a Modi coalition government, which on first sight, okay, I consider it to be neutral because it means we're not going to get anything different than we got in the last 5 years. And given also that in the last Modi administration, we had some form of majority in Lok Sabha, in other words, Modi could pass legislation without necessarily relying too much on coalition. Now it is very likely we're going to have a coalition, and therefore the capacity for any further economic reform or structural changes in the Indian economy via changes in legislation is going to be effectively zero. First reaction is going to be neutral, and my second reaction is going to be negative.
Thanks, Andrew, so much for taking out time for us, telling us what do you expect from the Indian market, various asset classes, and of course the ongoing tariff issues.